In this video, we're breaking down 3 high-risk stocks that could quietly turn into life-changing investments over the next few years. These are companies operating in industries that are exploding right now, from digital payments, infrastructure, to next-generation AI hardware, to mission-critical public safety systems, and each one has the kind of asymmetric upside that can turn a small investment into something much bigger if the execution is right. One of them is already showing strong revenue acceleration in a niche most investors ignore. Another is positioned at the center of the AI compute wave but is still flying under the radar. And the third is tied to global security infrastructure where demand is becoming non-negotiable. Let's get straight into it. We're starting with a company that most retail investors completely overlook, yet it sits right in the middle of a powerful long-term trend. 𝗗𝗟, ticker symbol PAYS. Before we get into numbers, you need to understand why this business matters. 𝗗𝗟 operates in specialized prepaid card programs, not general consumer payments, not peer-to-peer apps, but targeted solutions for industries that require compliance, tracking, and reliability. This includes healthcare, pharmaceutical assistance programs, corporate incentives, and government disbursements. This is important because these are not casual use cases. When a pharmaceutical company sets up a payment system to help patients access medications, that system becomes embedded in their workflow. It is integrated into operations, compliance processes, and reporting systems. That creates switching costs. And switching costs create stickiness. Once a client is onboarded, they are far less likely to leave unless something breaks. Now here is where the long-term opportunity starts to become clear. 𝗗𝗟 has been expanding aggressively in the pharmaceutical space. Drug manufacturers are increasingly offering financial assistance programs to help patients afford treatments, and those programs require secure, trackable payment systems. That is exactly where 𝗗𝗟 fits. This is not just a payments company. This is a company embedded in healthcare financial infrastructure. And infrastructure businesses, when they scale, can become extremely powerful. Now let's talk about growth. According to analysts, 𝗗𝗟 has been delivering strong revenue growth driven by increasing adoption of its pharmaceutical programs. As more programs launch and more patients use these cards, transaction volume increases. And this is a volume-driven model. More transactions lead to more revenue, and once the infrastructure is in place, incremental transactions come at relatively low cost. That creates operating leverage. So as the company grows, margins can improve faster than revenue. That is one of the most important dynamics in small-cap investing. A business that scales efficiently can surprise the market very quickly. Now think about this. If 𝗗𝗟 continues adding new pharma clients, and each of those clients brings recurring transaction volume, you are looking at a compounding system. Revenue builds on top of existing revenue. That is how you go from a small company to a much larger one. Now let's address the risk, because this is not a risk-free investment. 𝗗𝗟 is still a small-cap company. It does not have the diversification of a large enterprise. Client concentration is a factor. If a major client reduces usage, it can impact revenue, and the payments space is competitive. But here is the counterbalance. 𝗗𝗟 is not trying to compete broadly. It is focusing on a specific vertical and building expertise within that vertical. Specialization can become a moat. Over time, being deeply integrated into pharmaceutical payment systems can create a competitive advantage that is difficult for others to replicate. Now let's talk about why analysts see upside. The growth in pharmaceutical programs is expected to continue, and as transaction volume scales, revenue growth can accelerate. Analysts are modeling continued expansion, and when you combine revenue growth with improving margins, you get a setup where valuation can re-rate quickly. This is where small-cap stocks can move fast. The market often waits for proof. Then once that proof appears in the form of consistent growth, the stock can reprice rapidly. Now think about positioning. You are not buying 𝗗𝗟 because it is already dominant. You are buying it because it is early in a niche that is growing and becoming more important. And if the company executes, the upside can be multiple times the current valuation. That is the type of opportunity that attracts investors looking for asymmetric returns. Now here is the question you should be asking yourself. How many companies are quietly embedded in healthcare financial systems, growing transaction volume, improving margins, and still relatively under the radar? Not many. And that is exactly why 𝗗𝗟 is worth paying attention to. If this resonates with you, you're exactly who this channel is for. People who are ready to stop losing money in the market and take their investment portfolio to the next level. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move to the second company, and this one sits right in the middle of one of the biggest technological shifts happening today. Blaze, ticker symbol 𝗣𝗟𝗨𝗦. Most investors hear artificial intelligence and immediately think about massive data centers and cloud computing. But there is another side to AI that is just as important, and in many cases even more critical. That is Edge AI. Edge AI means processing data locally, close to where it is generated, instead of sending everything to centralized servers. Why does that matter? Because latency, bandwidth, and security become major constraints when everything relies on the cloud. If a system needs to make real-time decisions, whether it is traffic control, industrial automation, or defense applications, it cannot afford delays. It needs intelligence on site. That is exactly what 𝗣𝗟𝗓 is building. The company is developing hardware and software designed specifically for edge AI workloads. Now think about the implications. As AI becomes embedded into everyday systems, from smart cities to autonomous technologies, the demand for efficient, localized processing will increase. This is not a niche trend. This is a foundational shift in how computing is done, and companies that enable that shift can become extremely valuable. Now let's talk about why analysts see upside here. 𝗣𝗟𝗡 is still early in its growth phase, which is why it carries higher risk. But early-stage companies in emerging markets can scale quickly if adoption accelerates. The company is positioning itself as a key player in enabling real-time AI across multiple industries. And demand is already building. Governments and enterprises are investing heavily in smart infrastructure, automation, and AI-driven systems. That creates a growing market for edge AI solutions. Now here's what makes 𝗣𝗟𝗡 interesting. It is not just building chips. It is building an integrated solution that combines hardware and software optimized for edge environments. That integration matters. Customers are not just looking for components. They want systems that work efficiently together. And when a company controls both hardware and software, it can optimize performance and create stronger long-term positioning. Now let's address the risks. 𝗣𝗟𝗡 is not yet a mature, highly profitable company. Revenue is still developing. Execution risk is significant. Competition in the AI space is intense. And scaling hardware businesses requires capital and strong partnerships. These are real risks. But here is the upside scenario. If 𝗣𝗟𝗡 secures key partnerships and deployments, revenue can scale rapidly. And because the market is still identifying winners in edge AI, valuation expansion can happen quickly once traction becomes visible. This is the kind of stock that can remain quiet for a period of time and then move sharply when momentum builds. Now think about positioning. You are not buying 𝗣𝗟𝗡 because it is already proven. You are buying it because it is positioned in a space that could become essential over the next decade, and if it captures even a small share of that market, the upside can be significant. Most investors wait until a trend is obvious, but by then much of the upside is already gone. The goal is to identify where the world is going before it becomes consensus, and edge AI is one of those areas that is still early. Now before we move to the third company, which operates in a completely different but equally important space, there is something you should know. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the final stock. The third company operates in a space where demand is not optional and where the need for reliable systems is increasing globally. Genesis, ticker symbol GNSS. Before we talk numbers, understand the importance of what this company does. Genesis provides critical communication systems used for emergency alerts, disaster response, defense coordination, and public safety infrastructure. This is not a discretionary service. When governments and agencies invest in these systems, they are addressing real-world risks that require immediate, reliable communication, and once these systems are deployed, they are rarely replaced quickly. That creates long-term relationships and recurring opportunities. Now think about global trends. Extreme weather events are becoming more frequent. Urban populations are increasing. Governments are under pressure to improve emergency response capabilities. All of this drives demand for advanced communication systems, and that is exactly where Genesis operates. Now let's talk about growth. The company has been expanding its emergency warning systems across different regions, increasing its global footprint. This includes mass notification platforms capable of alerting large populations in real time. Once installed, these systems become part of public infrastructure, and infrastructure tends to be durable. Now here is an important factor analysts are watching: backlog. Genesis has been building a backlog of contracts which represents future revenue that has already been secured but not yet recognized. Backlog is critical because it provides visibility into future growth. When backlog increases, it often signals that revenue will follow. Now let's talk about risk. This is still a small cap company. Revenue can be uneven depending on when contracts are awarded and completed. Government sales cycles can be long, and execution matters. If projects are delayed, it can impact financial performance. But here is the opportunity. When contracts are secured, they can be large and long-term. That can lead to sharp increases in revenue and strong market reactions. This creates volatility, but it also creates upside potential. Now think about positioning. As governments continue investing in public safety infrastructure, companies like Genesis become more relevant. And once a system is installed, replacing it is not simple. That creates a form of stickiness similar to what we discussed earlier. Now let's step back and connect everything. You have 3 companies operating in completely different industries. Paysign is embedded in healthcare-related financial systems with growing transaction volume. Blaze is positioned in the future of AI at the edge, where demand is just beginning to scale. Genesis is tied to global public safety infrastructure, where demand is increasing out of necessity. Different sectors, different risk profiles, but one shared characteristic. Each company is aligned with a long-term trend that is not going away, and that is what creates the potential for outsized returns. Now here is the key insight. High-risk investing is not about guessing. It is about identifying companies where the downside is understood, but the upside is not fully appreciated. And in all 3 cases, the upside is tied to real adoption and scaling, not hype. Now think about your own strategy. If even one of these companies executes well, it could significantly outperform. If more than one succeeds, the impact on your portfolio could be meaningful. That is the power of asymmetric investing. Now here is the question for you. Which of these companies do you think has the strongest long-term advantage? Is it the one embedded in healthcare payments with compounding transaction volume? Is it the one building infrastructure for edge AI? Or is it the one focused on global safety and emergency communication systems? Let me know in the comments. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.